You know, the more I watch the markets, the more I see what's going on in the news, the more I realize how screwed up our country is about to be. Let's take away something really quick. A couple weeks ago, we saw the market rally a significant amount, probably more than it should have. But why was it actually doing that? Well, if we look at some sources, we see that the market began factoring in negative interest rates. Now that's something you've heard me mention where I didn't think Jay Powell was gonna do it, and I hope he still doesn't, but the more I look into it, the more I think he's gonna have to. So these past couple days, the market's been going up and down based on some economic news, it seems like, but that's not what I believe the entire case is. While at first glance, yeah, that did have an impact, what I really think is going on now is after Jerome Powell came out and said basically that he wasn't going to take rates negative, the market began to correct. Because if you look at this article, it had said that the market began factoring in negative rates, and because of that, the market was rallying. But since Jerome Powell basically shut down that idea and said anybody that thought of negative rates was basically stupid, the market decided to flip the switch and go bearish, and now has begun selling things off to correlate with the fact that negative rates might not enter the market area. Well, I don't think that's entirely true. I think negative rates will come into effect in these next couple months as economic conditions worsen and the market doesn't really begin to grow anymore. It kind of stays stagnant of where it's at, which makes it pointless to invest in. So investors will pull their money and the market will drop off if nothing happens. So in order to entice economic stimulus, negative rates will come about, just not anytime soon. It's going to be a couple weeks from now. So let's take a look today at what negative rates actually mean. Negative interest rates are just like they sound. It's basically when the borrower is credited rather than being charged interest on a loan. Now, how can that impact you? Well, the consumer in general would basically have to pay the bank to keep their money stored there. Now, you kind of see that as an advantage already. You're like, well, if my house burns down, all my cash is gone, so I kind of leave it in the bank anyways. The bank holds it for me, actually pays me interest for it, entices me to hold it. So negative rates would basically be like, hey, you're paying the bank X amount of dollars from the X amount you have in there for them to hold it and protect it for you in the time being. Which, makes sense, but for the consumer kind of sucks because we're not used to that. But that's probably the word we're gonna have to come to in order for the government to start making money on all this stuff. So scenarios like this, negative interest rates, usually occur during a deep economic recession when monetary policy and market forces have already pushed interest rates to their nominal zero bound, which back in March, the Fed pushed the rates basically to zero. They were like 0.25%. And because of that, we have nowhere else to go but negative. If you take a zero, it's not gonna have much of an impact, so we have to go to negative rates. A couple countries have actually already implemented negative interest rates, Switzerland being one, Japan being another. And while there's no proof that negative rates actually benefit anything, it does stimulate an economy to an extent. Let me explain how, okay? Picture you're a consumer. Like I mentioned earlier, you're gonna be paying the bank to basically hold your money. You don't wanna have as much money in the bank as you can because the more you put in there, the more you're gonna have to pay the bank to watch after it, right? It's like a babysitter for your money, which is kind of weird because it's just weird. So you're paying the bank to hold your money and you don't want to put as much in there, so you basically hold more cash on your person than you do in the bank, or maybe you hold more cash than you normally would. And right now, if you look, savings and checking accounts have actually increased exponentially since this. So people are clearly hoarding cash during this time. So that's kind of the reason I think negative rates will occur, is because the more people that hold cash, they're gonna have to have a reason to get people to pull that cash back out and get them to spend it back in the economy. And by doing that, negative rates is the only way to get people to pull that money back out and hold it. If people physically hold the cash, I'm a believer that the more cash you see you have, the more likely you are to spend it, because you're like, well, I've actually got a pretty big stack here. I could take a little chunk and spend it and do what I want because I still have an enormous stack left. That's how a lot of people think. It's really weird, but that's the gist of the consumer. Another reason for the negative rates is the corporations that have huge amounts of cash in the banks. More inclined for them to take the cash out, actually buy something, invest it in something else, do some stock buybacks, more purchasing, which would, in theory, again, drive up the market. So there's multiple reasons for negative interest rates. Now, where it could deter and have an issue. If you remember in the last video, we talked about deflation. It's the dark matter of the economy, stuff that a lot of economists don't like to talk about, but it does exist. During deflationary periods, People and businesses hoard money. As we've clearly seen, savings accounts, checkings accounts, all that have grown astronomically in the past couple months because people don't like the uncertainty that's going on right now within our economy. This results in basically a collapse of the aggregate demand for products, supplies, whatever it may be. It just begins to collapse because people aren't going to be spending as much money. Clearly, that's how economics works. Supply determines the amount you're going to produce. Demand determines the price of things. And when the aggregate demand begins to decrease, so does the price. Along with price decreases, this also leads to a slowdown and a halt in real production, and also leads to an increase in unemployment, which is possibly why our unemployment numbers have still been going up. Now, some of the biggest corporations out there today, one of the ones I like to think of is General Electric, because my father actually works for them, so he's always mentioned that company to me. The winners for negative interest rates are companies with enormous amounts of debt. These negative interest rates would decrease the cost of borrowing money. So if a company has encompassed an enormous amount of debt, they would theoretically begin getting paid to hold on to that debt, which doesn't make sense for the banks because these companies that have basically been losing at this time will all of a sudden be winning because they get paid. Yeah, it's as confusing as it sounds. Now, vice versa, on the other hand, the companies that have huge amounts of cash on hand, Apple, will then begin to suffer because they will either A, as I mentioned earlier, have to reinvest that cash, or B, they will be paying enormous amounts of interest for the banks to continue holding that cash. So clearly, negative interest rates pose a positive outlook and a negative outlook for some companies. Now that also will play an effect when you go to invest. Again, this is all about the investing segment. You have to be informed. You have to know how this is going to correlate. So if rates begin to go negative, if you start to see them drop, again, I think the Fed will eventually have to cut rates because the market's forcing them to. It's been dropping so much, it hasn't been going up anymore because it began factoring negative rates in at first, and now it's not factoring in negative rates, so it's decreasing. So if the Fed wants to do what it's going to do and doesn't want to lose all the money it's already invested in it, it has to cut rates negative so the market can go back up. It's very weird, but you got to think like the big dogs here for a second. So again, companies like Apple will therefore be forced to invest all of the cash that they're holding, which is kind of the reason for negative rates. While it may seem good, like, hey, I can go get a loan for a house and technically be paid for that loan. Yeah, but you're also going to have to be paid for the cash you're holding in your bank account. So look who's winning long term, banks. Negative interest rates also make low risk sources of investment income, try saying that 10 times fast, such as savings accounts, CDs, treasury bonds, unappealing. The lower interest rates fall, aka going negative, the fewer viable options investors have and more money flows into stocks, driving share prices higher. So watch that. Watch these negative interest rates. Negative interest rates will impact everything we have here in America. They will benefit companies, they will hurt companies, but you have to know which ones are going to be impacted. Again, like I said, GE is a great one to have that has an enormous amount of debt. They've encumbered so much debt through this, so much debt over these past couple years because they've expanded so much. That's why their stock is so cheap that if rates go negative, all the debt they're holding will actually benefit the company in the most extreme, weirdest way that's ever happened in the history of the world. So companies like that, again, companies like Apple that hold huge amounts of cash in their banks and their accounts will have to pay to hold that cash. So they're basically going to be spending more money than they're making, and now they're going to have to spend even more money to hold that money that they were making. Yeah, welcome to negative interest rates. So nonetheless, guys, I wanted to do a quick video covering these negative interest rates because as much as I hate them, I think they're going to become a reality here in these next couple weeks, probably in the next couple months, just because our economy, as we've said previously, is that screwed. Yeah, I'm sorry, but we are. So watch that. Unemployment numbers have been increasing. Savings accounts have been increasing because of stuff like that. So be mindful of that, guys. Watch that. You're an investor. You know what to talk about. You know what to look for. And this is Life with Kyle. Welcome to our Investing 101.